Nick, 3,000 ETFs, less than half the number of mutual funds that exist, but it's still quite an achievement. We had one fund in 1993, one ETF. The market grew to 102 funds by, 2002? Nearly 1,000 by the end of 2009, 3,000 today. How are investors using all of these ETFs? You know, most of the money seems to be going into index funds, but we see an increasing number of active strategies, especially this year. We've been talking about single stock ETFs. What's your take on it?
Yeah, investors are using them in kind of the way they're being developed. So we started off by basically taking very broad index funds. SPY was the first one, obviously. And then the industry over the years built all these interesting overlays. So sector funds came along pretty soon after that. Emerging market, EFA funds, big themes. Then we drilled down into investment themes like clean energy or legal marijuana or 1,000 other themes that might work. And investors now are really spoiled for choice among just being able to pick not only the big sector funds or the big overall funds, but any kind of theme they think might be interesting.
Yeah, so it's gone from disruptive innovation to sort of mainstream. They're just now trying to figure out new ways for increasing revenues, essentially, at this point here. Charlie, you're one of the founders, the fathers of the index revolution. Your 1975 essay, Winning the Loser's Game, pointing out the value of indexing at a time when there was no investable index. That's a classic today. I just reread it a few weeks ago. What do you make of the rise of all these ETFs? Do they help or do they hinder the index investing story?
It depends who you are and what you're trying to do. Most of the people who are buying into ETFs are using it as a vehicle to get into index funds. They're going to do fine. People who go after the highly specialized ETF are at real risk of making serious mistakes that they will obviously suffer from. The more you get specific, the more the odds are high that you won't be able to make a rational long-term decision, and you will get suckered into making, because we're all human beings, making an emotional short-term decision, and you won't like the outcome in the long run.
You know, I can't help but hear Jack Bogle's voice in my head. If he was here, he would say, you know, Bob, you keep talking about these thematic tech ETFs like cybersecurity ETFs, and you know, in the long run, it's not going to matter that much. It all kind of blends together after a while. That would be what Bogle would say, wouldn't you think?
Well, that would be true, but you have to understand, Jack was never very enthusiastic about ETFs. Yeah. When Nathan Most first went to him with the idea, Jack said, no, this was all speculation and ridiculous. I won't have anything to do with it. And it took several years for Vanguard to overcome Jack's original rejection and to come back into the business. And it's really Gus Sauter who made the impact on Vanguard being a major factor in the ETF business, because he linked it to the index. Vanguard was already managed. Wonderful combination. But Jack was never really quite understood that most of the trading volume in ETFs are professionals hedging portfolios.
Yeah, that's a good point. You know, the first ETF, Nick, the SPDR, SPY, the S&P 500, is going to turn 30 years old in January. The fund is now the largest ETF in the world. It's one of the biggest funds in the world, $350 billion in assets under management. Quite a remarkable feat, considering we started not long ago.
Yeah, it's fascinating if you think, okay, that was exactly the right product to start with. It was something that everybody understood, and it's done fantastically well. What if we had started with an EFA ETF or an EM ETF and had that boom and bust cycle that we had in EM, or just have lousy returns like we've had in long-run EFA returns? Ironically and interestingly, we started with exactly the right product, literally the best product to start with. And I think a big part of the industry's growth is because that first product was a great one.
Yeah. And now it's grown, so we've got these 3,000 ETFs that are sitting out there at this point. They're all out there. What's amazing to me is still the majority are active management, or passive management, excuse me, but active is really kind of coming in here. Is this because all of a sudden the industry is maturing? There's only so many, passive funds that you can put out there. And what do you think of that? What does it mean when you have a lot of people who are in mediocre mutual funds converting to ETFs? You're still a mediocre fund, right?
Well, there's a lot of associated fees with a mutual fund that you get less of in an ETF, and you have less of a tax liability as well. The math I've seen says an ETF wrapper on a mutual fund can boost returns by as much as 50 basis points. So yeah, if you're a lousy manager, you'll still be a lousy manager, ETF or mutual fund. If you're right on the cusp, it might actually help, and you don't have to hold cash. which is a huge advantage in the mutual fund structure.
Charlie, you've got two new books coming out. One of them is called Figuring It Out. That is a collection of your best investing essays, including Winning the Loser's Game. There's the cover. And another called Inside Vanguard. It's a history of Vanguard and the legendary Jack Bogle. And we've talked about him a few minutes ago, but Jack passed away, what, in 2019, Charlie? I'm wondering, what would he say to investors who are seeing the S&P down 19% this year? What kind of advice would Jack Bogle give all those nervous investors?
Well, Jack Bogle would do the same thing the Bogleheads have been doing for years, and that is be a long-term investor. And if you're going to do long-term investing and be successful, first thing you want to do is know yourself, then develop a serious plan that you will stick to and stick to and stick to through thick and thin, and index keep costs down, because that really works well. ETFs and indexing are either pathway that you find right for you is fine, but staying out of active investing is really an important part of the total decision. And if you did all of that sensibly and hang on for the long run, you're going to come out fine.